The idea of compound interest is that it's a better reflection of what's actually going on. Simple interest, if you remember, is a formula that looks like this. And it's a formula which is actually easier to use, right? All it does is it calculates the interest, or we call that the extra amount, on when you put, for example, money in the bank. Ben, do you have a bank account?
Yeah.
Yeah, who do you bank with?
Police bank.
Which one?
Police bank.
Police bank. Okay, there you go. Yeah. Is it like for just for police, people in the police force, or?
Yeah.
Yeah. So there's a lot of banks that we call them kind of like union banks. So for example, there's like a teachers mutual bank, which typically teachers and their family and relatives will use and things like that. So I assume that that's the same kind of thing. What other banks? Anyone with Bendigo? Anyone with Bendigo Bank? Yeah, Bendigo, yeah, referencing the Bendigo. Commonwealth, did you say? Combank Clan. Yeah. Yeah. All right. So, when we look at compound interest, the formula is a bit more complex because that reflects the reality of the situation. That banks will use compound interest to calculate your extra payments, and that's actually what you want because compound interest. So I'm on freeze. Compound interest is actually, when we think about it, considering the growing amount. So the principal, which is what you start with, the formula that we use now over here actually considers the growing amount as well. Whereas this one, the principal remained the same the whole time, right? This calculation over here considers a growing principal, which means for you guys basically that you will get more money. Now, in the mathematics course, we sometimes refer to this as a future value, or FV. PV, what do you think that stands for? Present value, good. Yeah, that's what it's worth right now, right? And all of these values here, they define for you as well. R is the rate, N is the number of periods. Next to that, what I need you to do is I need you to actually write the rate. I want you to write it as a decimal. There's a few ways you can write it. You'll be given to it usually as a percentage, but I need you to write it as a decimal. So I need you to write the rate as a decimal. N is the number of periods. What do I mean by that? Well, what I mean is periods can refer to any kind of time period. For example, the most common one is each year, right? But you have to be really careful. Sometimes, and I'm going to put a little exclamation mark here, sometimes you'll have to check and you'll have to look at, they may want it for each month, or they may compound things quarterly. So just be aware of that. They can change how often they compound things, and that will affect the number of periods you're doing that. I'll give you some example of that later on. Okay. Now, just to make it really clear, FV, that's the future value. That's what it's going to be worth in the future. If you're just interested in the interest, right? If I'm just interested in the extra amount, what do you think this formula is telling you to do? If I just want the extra amount there? Because the future value, that's what it'll be worth in, 5 years or 10 years' time. But if I want to compare how much extra I've got, you have to do a calculation. What are they doing here in this formula? Yeah? Yeah, how do they do it? What are they doing here? They subtract, right. So basically what this formula is saying is, right, if I have something that's worth a particular amount in maybe 5, 10 years' time, I have to take that away. I have to subtract it from the original amount, the present value, to see how much extra I'm getting. Does that make sense to you, 11? That's the idea with this. Right? Year 12. Year 12. 11. Okay. So, let's